So there is a benefit to keeping assets in an IRA. What's the downside? The downside of keeping assets in an IRA or a 401k or a qualified plan is that at death, it's included in your estate for estate tax purposes. So if I have $5,450,000 exemption from the estate tax, and I have $7 million, and that's my only asset, that's exaggeration, but it's my only asset in a 401k account, what's going to happen? $1,555,000 is going to be subject to federal estate tax, and depending on the state I live in, more than that may be. And I'm going to have to bust that qualified plan. And I'm going to have to pay ordinary income tax on it. So not only am I paying 40% estate tax, plus whatever state death tax I have to incur, I'm going to have income tax. So the effective tax rate may be 60, 70%, depending. That's not good planning. So it's a balancing. We get asset protection, we get tax deferral. One of my clients 2 days ago, he said, I'm putting, $350,000 in my defined benefit plan again this year. He's 70. I said, how much is in that plan? It's $4 million. I said, we need to talk about planning to avoid any unexpected results if you died next year or the year after. What are we going to do to protect that asset from being busted and being subject to not only estate tax, but income tax? The IRA Legacy Trust is a way around some of the beneficiary designation issues that I talked about. It's also a way around some of the bankruptcy issues. Who said, Gary, did you mention rollover? So if I have a 401k and I roll it over into an IRA, my own IRA, that is protected in bankruptcy, unlimited. That is protected. That's the, I can't remember the name of the case now, I just read it. Clark versus Raymond, U.S. Supreme Court last year. But what they also said was, any rollover from an inherited IRA is not protected. And the rationale they use, which somehow makes some logic, but I don't necessarily agree with it, is that the person who inherited the IRA wasn't the participant in the plan, didn't work for it. And that's what it was really. The IRA rules, 401k rules, qualified plan rules were designed to protect the worker, not the inheritance. So there is no asset protection in a rollover of an inherited IRA. No pure asset protection.
Wait, let me get this clear. You said that previously that there was a maximum amount that was protected under bankruptcy of up to $1.34 million.
There still is a maximum protection under bankruptcy law of $1.345 million for an IRA.
Not a rollover.
A rollover from a 401k is going to be protected. Yeah. So an IRA legacy trust, as we refer to it, is a special purpose trust. It can be a revocable trust that you set up separate from your regular revocable trust just to handle your retirement assets. And in that trust, if you structure it properly, it can be either a conduit trust or an accumulation trust, which I'll get into in a second. Either way, it qualifies for rollover treatment for a spouse and for kids, so you can actually stretch out the payments over the life expectancy of the designated beneficiary under the trust. So the trust beneficiaries can be your spouse and can be your kids, but you can maintain more control over the assets here. It has to qualify as a designated beneficiary, and I'll get into that in a second. What's your question?
Why does it need to be a separate trust?
It doesn't have to be. In many of our cases, we'll set up our revocable trusts to be conduit trusts, which do qualify as designated beneficiaries, regardless of who you name or how you name them as beneficiaries. And so you can have your IRA pour into your revocable trust and still have it stretched out over the life expectancy of the oldest named beneficiary. If it's a conduit trust, it would be the oldest child. So let's say you had your kids named as the beneficiaries, and then after that you named a charity, or you named an older individual. The general rule under IRA, designated beneficiary laws is you take the age of the oldest beneficiary, even if it's a contingent beneficiary. So if all your kids are deceased and you had named your mother as a contingent beneficiary of the trust and the IRA pours into the trust, if it's not a conduit trust, then you use the mother as the measuring age of the stretch. Following me? Okay. But if it is a conduit trust, you can use the oldest child as the measuring age of the stretch. So our typical default is if we have an IRA pour into a revocable trust that we draft, it's going to be a conduit trust. That gives them flexibility in naming remote beneficiaries later on. But there's many other ways of doing this. And so if you're concerned about it, this is a great way to do it. It's also really important to use this in community property states. So if you have any clients that are in Texas, California, Wisconsin, Idaho, et cetera, there's 12, 13 community property states, and I do, we'll create a joint revocable trust for their basic estate planning because you get a double step up in basis on the death of the first spouse if assets are held in a joint revocable trust. How many of you knew that? It's really obscure. Okay, that's community property states only, not Virginia or Maryland or DC. So if you do that, and you had your IRA paid into a joint trust, the IRS has actually ruled on multiple occasions that it busts the IRA. It forces you to recognize income on the IRA or the 401k immediately. That's not a good result. So this is another reason we use IRA legacy trusts. So for my clients who are here, but moving to Texas or California or other community property states, we'll do a joint revocable trust and an IRA legacy trust. So if you've seen that from me, that's one of the reasons why we do it. So there's two types, conduit trust and an accumulation trust. A conduit trust says that the required minimum distribution, which is based on the life expectancy under IRS tables of the designated beneficiary, must be taken every year. And it has to be paid out, not only from the IRA to the trust, but from the trust to the beneficiary every year. Has to be paid out. So the advantage is the beneficiary pays the tax on the required minimum distribution instead of the trust. Why is that an advantage? Trust rates are higher at lower levels of income. At $12,100, you pay 39.6%. At $450,000 for married couples, indexed for inflation, you pay 39.6%. So you can see the benefit of paying it out to the beneficiary. It's also stretched out in a conduit trust. The disadvantage is that once you make the distribution out of the trust, there's no asset protection. So I like asset protection for my clients because I've got a lot of clients with kids who like to spend money or who have made bad decisions on spouses, et cetera, et cetera, et cetera. So what do? We try to build in some asset protection if we can. If we can't, one of the things you can have the IRA legacy trust or your revocable trust that's a conduit trust do is have the trustee pay it out for the benefit of the beneficiary. So if the trust has to distribute the required minimum distribution, but they use it for the kids' rent or car payments and just make it directly to the vendor as opposed to giving it to the kids so that they can go to the bar instead of making the car payment, it still qualifies for a distribution. That's why I like having assets, like retirement assets, get into the trust, so at least if they have to be paid out, we can pay it out for their benefit, for their own individual benefit. If it's distributed, of course, it's available for collection by a divorcing spouse or other creditors. The accumulation trust is a little bit different, but you have to be careful about who you name as beneficiaries. Remember earlier I said you might name your kids as the primary beneficiaries, but if they're not around, God forbid, you name your mother or a charity. Well, those do not qualify as designated beneficiaries in an accumulation trust it'll destroy the ability to stretch out the benefit. So in an IRA legacy trust, if you're going to create an accumulation trust, you want to be careful about who you name as remote beneficiaries of that trust. And in this trust, while you still have to pay out the required minimum distribution from the IRA each year, the trustee can accumulate and pay tax on it, but they can accumulate it or distribute it or use it for other purposes. So it's completely off the table. This is an asset protection technique, and the IRA Legacy Trust does achieve that. The big disadvantage is we have this compressed income tax table applicable to any trust income. Questions? Question, Gary.
As far as how this is set up, is it one trust that applies to all people, or do you have separate trusts for each person?
You'll have a trust that upon your death, it may split into separate trusts for each beneficiary. And then you actually can achieve rollover treatment for the separate beneficiaries.
How do you tell if it's a conduit, whether it qualifies? People come to us saying, here's my trust, and I'm not an attorney, I have no idea. If this
Give it to your
qualifies.
attorney who knows about conduit versus accumulation. I mean, we can tell pretty quickly. It's provisions, there should be provisions. If you look at our standard revocable trust, it's like Article 13 in a married couple trust. If you look in the back, it'll have provisions about retirement plans and life insurance. In that section, it's always a conduit because we can never guarantee that the remote beneficiaries will be at the same age or younger than the children. And so if we name a charity or something as a remote beneficiary, it will not be a conduit trust.
So if you do a conduit trust, instead of listing the spouse as the primary, you're saying you list the trust as the entire beneficiary, and within that trust, the spouse gets it first? If they're
Maybe.
still alive, or not? Okay.
It's all custom. You know, it's custom designed. Does the spouse get it first? Do the children get it first? Depends. You know, 50% of all marriages have been through a divorce at least once. Age 18 to 55 in the United States. 50% of all people have been divorced at least once. So if they're second marriages or third marriages, or in some cases my clients' fourth marriages, and they have kids from the first or second or third marriage, they may want some of those assets designated to the kids from the earlier marriage as opposed to just the surviving spouse. And then there's tax planning that has to go around as well. So in an IRA legacy trust, who should be the trustee? That's the big question. That's in this book, Successor Trustee Manual, which is available online on blueprintforwealth.org. You can buy it there. Get them for your clients, hand them out. It's very useful because it talks about the issues that you're going to face in advising your clients, or they're going to face as successor trustees. It's beyond the scope of this session. We could spend a whole session talking about it, and I have done that in the past. But you could name a kid, but if you name a kid as the trustee of a trust, and they are the beneficiary of the trust, then there's no asset protection. And if you want to make sure that the kid doesn't just take the asset out and spend it, then what do? Maybe it's a family member, but maybe you don't have family members who are savvy enough to make the right decisions, which is a lot of the case. So then maybe it's a friend, but what if the friend dies? Maybe it's a professional trustee, maybe it's a bank, maybe it's a trust company. These are issues that we talk about a lot in our sessions with our clients when we're having the review of their estate plan. Every situation is different. There is no boilerplate. If you're seeing boilerplate, then it's not being planned properly because every situation is different. So the idea of IRA and retirement planning is try to plan now. Do an IRA legacy trust or don't. Use the revocable trust with a conduit structure, but make sure that you're not just leaving the asset to the kids, even if they're 25. I mean, some of us have kids that are 25 or 30. They're not ready. Not all of them are ready to get the asset. Others are. And I credit you as parents for doing a good job in raising those children to be economically frugal or fiscally responsible. We don't want the state to write your estate plan. That's the bottom line. So everybody needs a will. Everybody needs a trust. You can have an IRA legacy trust. We're using them more and more in our planning. Everybody needs a healthcare power of attorney and a regular power of attorney. And everybody needs a living will.